Good afternoon. Nice to be here. It'd be probably nicer to be in some sort of dramatic location with you all, but I recognize the times are different as far as that happens these days. I don't know if I need to share my screen right now or not to start with the presentation or go right into it, but I do want to talk about oil markets in the time of coronavirus. And just to set the stage for you, so to speak, a couple days ago, it was the first anniversary of a bombing in Saudi Arabia that knocked out, for the moment, about 5 million barrels a day of crude oil capacity from the Saudis, September 14th, 2019. And we briefly, after that weekend bombing, we saw prices go up to somewhere in the neighborhood of about $71 a barrel. Less than 6 months later, or perhaps about 6 months later, we saw prices for crude oil go down to $42 a barrel. So negative $42 a barrel, I should say. So it's just been an incredible landscape that we've seen in the last few years. I mean, to put it in perspective to where we are right now, we're going to start fall here in a couple of days. And we're going to start with about 30 states are going to have the lowest motor fuel prices that they've seen since 2004. So, you know, these really are some sort of interesting times. We're going to spend about $700 million a day on the gasoline that gets us around, as opposed to $1.4 billion a day I'm thinking, 6 years ago in 2014. So it's really, you know, quite a difference here. Okay, so let's talk about oil prices in the time of Corona. And first of all, I'd like to let you know, okay, I do a lot of TV. I do it because they come to me, and quite frankly, there's a quote that I always recollect where it's the most dangerous person in the world is the articulate incompetent. I like to frame it a little bit differently and say the most dangerous person in the world is the articulate incompetent with really good hair. Hopefully that continues for me, and you know, I'll continue to sort of occasionally get a little bit of attention. I want to look at it and talk about how COVID-19 is like the guest that won't leave. And how is that so? Well, you know, it's obvious that it had some dramatic impacts on road transportation demand, on gasoline and diesel. Now, it's also had an impact on jet fuel demand, where it's cut jet fuel demand to probably 40 or 45% or less of what would be normal. I think this morning we're looking at about 900,000 barrels a day of jet fuel demand versus about 1.9 million barrels a day a year ago. To put that in a different perspective, we have about 44 days supply of jet fuel, and it's only commanding a couple of dollars above the price of crude. So it is very much, you know, even though most of us don't probably think about it, except when we take a commercial flight or whatever, it's having a drastic impact on refining. Every refiner out there across the United States, and really in the world right now, wants to make sure that they are making as little jet fuel as possible. They might be able, and this is an oversimplification, to make a little bit more diesel fuel and a little bit more gasoline, but neither of those products are very terrific either. Both of those are selling for single-digit numbers versus crude oil costs. And just to put it in perspective, I mean, refiners were making an awful lot of money in the last decade. Nowadays, that is pretty much over with for the moment, and it's been over since COVID began, and it was even starting to disintegrate a little bit before that. You know, it's my premise and it's my view that probably refiners have overbuilt. We've overbuilt on the notion that, you know, fuel demand is going to be spectacular, not just in North America, but in South America and Central America as well. And when something like COVID-19 pops up, it really alters some of the best laid plans, and it really has a dramatic impact on what happens across the refinery side. Now, I know that most of the people on this webinar or this virtual conference aren't probably going to raise any money via telethons, you know, for refiners, but they really have gone from kind of Renaissance levels a few years ago to what I would call dark ages. And I think they're looking at the notion that maybe the landscape of North American refining is overbuilt. And again, the inventory context, when we were using 9.3 million barrels a day of gasoline and about 4 million barrels a day domestically of diesel and a couple million barrels a day of jet fuel, it was a balanced market. But guess what? In the time of Corona, it's not much of a balanced market at all. So we've got the dark ages really for producers. We've got darker ages for refiners right now. But there is a Renaissance segment. I'm going to talk about that a little bit later. But the Renaissance segment out there, and the segment that's getting a lot of attention from private equity and from Wall Street, is the retail section of all places. I wish I owned a retail station. Now, here's a look at how refiners basically altered their run. They were responding to COVID and the tremendous demand destruction. And the graph on the left there shows, you know, the notion that in April and May, when we were worried about the Hot Pockets heiress and her battle, that we dropped down to about 50% of traditional demand. And we also saw crude runs go down to about 50%. We've kind of responded somewhat to that in the last few months, but we're nowhere near back in terms of petroleum consumption as we were in 2019. You may hear me quite a bit in this presentation refer to 2019 as the last normal year. I think that's going to be the case for a while. You know, this is not going to be a motivational sort of speech for refiners, but I think it's going to be real, and I think it's going to be what we need to prepare for. And this is what it means to all the gasoline and diesel markets out there. For gasoline, you know, really the refining returns on everything they make at a refining plant have been miserable, downright ugly for the last few quarters. It's a little bit better than it was in the second quarter of 2020, but the third quarter, where usually you make hay with the driving season and so forth, it's been very, very disappointing for refiners and really for a lot of people that are in the supply chain. The difference is it's been pretty good for motor fuel retailers, and I'll explain that in a moment. If there's no improvement, I think what we're looking at is we're looking at thinning the herd. We're looking at refineries in the next few months, and really maybe as soon as sort of the October week when most of the public companies talk about earnings. We're looking at them thinning the herd. And I think there's a number of refineries. We've seen 3 that have closed in North America. The refinery that Marathon bought from Endeavor in Martinez, California, a small refinery in Gallup, New Mexico, and then another refinery that was operated in the Canadian Maritimes by a company called North Atlantic Refining Limited. Those 3 are closed. There are others that are being contemplated, and it's my belief, and I could be wrong on this, that we're going to see some other ones shut down, perhaps temporarily for the rest of 2020, and perhaps the first quarter of 2021, or maybe permanently. We are going to see some permanent closures in Europe. Uh, you know, margins for gasoline have cooled off in driving season. They've cooled off for refiners. They never got white hot. They were terrific for retailers. You know, there was a retailer that you're all familiar with, Casey's, that I think posted profits in a quarter that ran, I believe, May, June, and July, and they were about 40 cents a gallon. I mean, these are numbers that would have been regarded as sort of 1 day or 1 week events a while ago. But that's what happened this year. Now, we've come off since then. You know, they're not making 40 cents a gallon anymore unless you happen to be on the West Coast. But it has been very, very prosperous in terms of profit, the profits that are seen at the pump. I'm a little bit worried that we might be seeing an overbuilding boom in all of the fueling stops across the country. You know, you're probably familiar with the fact that BP earlier this week said that the highest global demand for petroleum may be in the rearview window. I don't know necessarily whether I would agree with that on a global basis, but I think I probably would agree with it in terms of North American demand. And that's not to say that it's going to be sort of disserved by a move towards electric or whatever. I don't think electrons are going to be the major competition in the next few years, certainly in the second half of the decade. But I think traditional fuels will prevail, but we're not going to see those demand numbers that we saw in 2016 through 2019. And I'll talk a little bit more about that in a moment. Diesel's been impacted by demand destruction. Today was the day the EIA released its statistics for the week ending September 11th. And it showed the lowest diesel demand in a September week in the United States since 1997. That's a long period of time, particularly when you look at population increases and so forth. Some of us look at diesel demand numbers, not in a week, but maybe over 10 weeks or 15 weeks, and we conclude that that could be a sign that the economy is stalling, or the economic growth or the recovery stalling a little bit. I think it's early to say that, but when you see a week where demand is only 2.8 million barrels a day, and it should be probably above 4, you start to wonder about it. So we're watching that, monitoring that very, very closely. One of the other trends you're going to see in fueling and in motor fueling is a rush to go public. A lot of gasoline retailers, and really all fuel retailers, have had just a tremendous few quarters. And it started a few years ago with margins improving pretty drastically for gasoline and for diesel. But it continued despite the demand destruction. Now, you could say that the demand destruction that we saw when coronavirus really started to manifest itself was temporary, and I would agree with that. But we were seeing margins that were more than twice as large as they were the previous year when demand was down about 46% for gasoline. People asked about it then, and you know, the answer was pretty simple. Well, if you're selling half as much fuel, you're going to have to make twice as much margin. And to a certain extent, a lot of the retailers had to give that up in terms of inside sales, and particularly with fuel sales. You know, one of the ironies here is that the less sophisticated retailers have probably done a little bit better than the sophisticated ones that added a lot of food service and inside space. But in any case, in addition to Casey's and Murphy and Couche-Tard and, you know, the big boxes like BJ's and Costco and Sam's Club, you're going to see some other public companies between now and the end of 2021. We'll probably see the company known as Yesway go public. We are seeing the filings this week for a company called Arco, not to be convinced with the old Arco, but that involves a roll-up of retail called GPM, and they will be public before the end of this year. So There's one thing when you're having a lot of prosperous quarters, and when Wall Street, at least on the private equity side, is very interested in gasoline retailing because it has a pretty high return on investment right now. They're going to take advantage of it. And we're going to see a lot of underwriting and a lot of companies going public. The warning I have is that a possible twindemic, and you've heard this term before, where we might have the pandemic of COVID-19 overlapping with the influenza virus in the fall or in the spring. And that could change the calculus for a lot of things, including profitability. Here's the good news on this, and none of us have really been traveling much, but in looking at some of the data from the Southern Hemisphere in places where, it is flu season because it's fall and, soon going to be winter in another 90 days. All of the early evidence indicates that social distancing is having the impact of suppressing the influenza epidemic in those southern climates. So that's good news. And that's probably about as good a news as I'm likely to share in this presentation. I want to look at retail profits and really what we saw in 2020 across the spectrum. Opus follows the wholesale price and we follow the retail price and we map them together. And look at these numbers for 2020 versus 2019. And just to give a perspective, 2019 was probably one of the best years on record. And 2018 and 2017 were very good years for fuel profitability. Once we saw demand go up to 9.3 million barrels a day, and it's very lumpy, it could be 8 million barrels a day in January and 9.8 million barrels a day in June, July, or August. We saw a lot more profit at the pump in the days of having a loss leader in the fuel and getting people inside to buy the jerky beef and so forth, kind of gave way to where fuel was not just the #1 category in terms of dollars, but it was also a great category in terms of what it brought back for people there. Now here's some observations as we get ready to start autumn 2020. And again, it's going to be a mixed bag. But it's probably, probably a few of them are reasons why I'm not going to be invited to a lot of places to be a motivational speaker. I'll be there to bring them down. Do not believe the data that you're getting from investment banks right now. A lot of them are really trying to cheerlead congestion and to get ahead of what has been kind of a meager recovery in gasoline demand and in diesel demand. We think, quite frankly, that the Energy Information Administration, not intentionally, but has been overstating US gasoline demand. I had a lot of conversations with big chain retailers this week to try to get a sense of what the drop-off was in the week after Labor Day. And I pretty much came up with about 16%. And yet, when we saw the numbers published, that's 16% from last year. It was another 2 or 3% lower than it was in Labor Day week. But the bottom line is we think that gasoline demand is probably about 8 million barrels a day. And that may be a number we have to get used to here as the leaves start to fall. That is much, much less than is indicated. And a lot of the banks will put out data on Apple Mobility or TomTom or other things that measure congestion. It's almost as though they're rooting for congestion to come back into our lives. Someone who lived in New Jersey for most of my life, I can tell you I don't like congestion very much. It can really make life miserable around here, or more miserable than normal, let's say. The bad news is we're seeing India with increased COVID cases, Spain and Italy as well. You got to really watch China. If China turns and we get some sort of second wave of pandemic there, I think that probably it'll impact the global economy and it'll keep that demand for fuel subdued in 2020 and 21, at least in the Eastern Standard Time months, or wherever your standard time is. I'm sorry to be a little bit East Coast biased in what I look at. Good news is that we don't believe the banks who are talking about, you know, a return to $80 a barrel, and you'll even hear a couple of wacky ones out there, and they're talking about, oh, we could go to $100 a barrel in 2021 if this happens. You know, I could have Jessica Alba and Scarlett O'Hara, not Scarlett O'Hara, Scarlett Johansson. Scarlett O'Hara's dead. Scarlett Johansson come over and have a barbecue with me, but the odds are probably against it. And I can tell you the odds are against crude oil prices that are not, or that are very dissimilar to what we've seen over the last year. We're not going to see negative prices again. That was a quirk. That was something that, quite frankly, embarrassed the exchanges. We're probably going to see prices in the 40s, and in 2021, if we do get a vaccine or vaccines, and our group IHS thinks that we might have some sort of widespread distribution of vaccines before the first 6 months of 2021 are over, you will see a recovery, and we'll see a recovery in oil prices. I mean, right now, the world is using more oil each day than it's producing. But you've got a number of countries, the Russians, you've got Saudi Arabia, some of the other Arab Gulf countries that are kind of limbering up their hamstrings to produce some more oil. But our forecast is for prices to look very much like they've looked through this summer, maybe get into the 40s, and maybe if everything goes really, really well with vaccines or with therapies, get to, say, $50 or $55 a barrel in 2021. Cheap oil continues to be in the backdrop for the next 16 months. If it's really cheap, that might mean that things are going badly in terms of epidemiology. But don't believe some of the investment banks. I think they're talking their book at the moment. You know, it's interesting because we look at gasoline, and gasoline is probably the product that's of most interest to people in the ethanol business. And there were periods of time there in the last 10 years where it would blow out to $25 over the price of crude, or $30, and on the West Coast, even $40 over the price of crude. We see gasoline as kind of a little bit of an unwanted hydrocarbon in 2020, for the remainder of it in 2021. So maybe it'll sell occasionally at $10 a barrel over the price of crude, or about $15 a barrel. That might equate, and boy, this is really a long way out to predict numbers for spring of 2021. But it might mean that we're going to see wholesale prices for CBOB and RBOB in the $1.50, $1.60 range. Higher prices on the West Coast. They've closed refineries, they're more disciplined there. But we're not looking at anything, you know, kind of crazy on that side. Okay. RINs, I think, you know, the price of RINs, I'm not going to get into that. I'm sure you're hearing from a lot more expert people, but that'll have a lot to do with the relationship between an RBOB and a CBOB and the price of ethanol. And I have no idea what the price of ethanol is going to do. I'm a long way from the corn here in New Jersey. I mean, not that long of a way. Actually, Jersey corn is pretty good, but I know it's not the kind that's used for ethanol. Day supply, we're going to flirt with 30-day supply of gasoline. To put that in perspective, after Katrina back in 2005, we got into the high teens for gasoline day supply. So there's a lot of fuel out there. You know, we have a surplus out there right now pretty much across all hydrocarbons. And for now, we think that's going to persist for a while. The second half of 2021, as I mentioned, looks a lot better. January and February look downright gloomy. We could see numbers of 7 million barrels a day for gasoline demand in January and February, even lower if we get a second wave of COVID, or if we get any element of that twindemic. but the second half might be better. The other problem for the winter is, we're starting to hear from the meteorologists who are mostly busy with hurricane observance these days. We're starting to hear about La Nina. And La Nina, we can talk about all sorts of different impacts of it, but the biggest impact is it tends to create a warmer winter in the northeastern part of the US and in Europe. And in those places, there's a lot of diesel molecules, hydrocarbon molecules that generate heat. So if it's a La Nina kind of winter, it could really sort of suppress prices, regardless of what's happening with COVID. Again, this is weekly profit per station on retail gasoline sales. I wish I had a retail gasoline station that I own. That would be much, much, much more prosperous than having a 401k or an IRA or anything along those lines. Here's the volume and margin trends over time. You could see that tremendous dip that we saw back in last spring or in the second quarter when we got to about 50% of consumption with the lockdowns. I don't believe we're going to see those lockdowns, but the other chart there, you can look at how gasoline margins reacted to that as well, and they moved much, much higher. But they've been on a slow road to more prosperity. Here's kind of a look at where year-to-date prices have been in the last 20 years or so and where they are now. Even though we started Labor Day with the cheapest prices for like about 30 states in 14 years, we're probably, when this year finishes, we're probably going to see average gas prices be about a little bit above where they were in 2016, which was the year until this year when we saw the shale prices go down, push WTI down to 20 cents a barrel. So not as cheap. Now, if you got into how much we're going to spend as a country this year, it's probably going to be the cheapest in the 21st century by far, since the average demand this year spread through a couple of normal months of January and February, and then through the pandemic, and what we see continuing through the rest of the year is going to be maybe 8 million barrels a day, or probably less, because there was a week there in April where we used as much fuel as we used in 1968 when Hubert Humphrey and Richard Nixon were pursuing their nominations to run for president that year. It's just incredible, incredible numbers. 1968, that's what we went back to. And there's been a lot of other standards like that, but we're seeing numbers that we haven't seen in decades and generations. Okay, I want to complete this in a moment with separating myth, legend, hope, and realism. And I hope I do this. Forget about negative crude. That was a quirk, embarrassing to the exchange. We're not going to see that. There's incredible discomfort what happened. OPEC plus countries have actually addressed the glut of crude. Right now, the cuts they have, eventually, with time, we're going to see the glut disappear. Most of that glut, by the way, is in two places: the US Gulf Coast, and particularly Texas. You might say all our X's is in Texas, kind of like a George Strait song, which I think was later done by Drake. And the other place that the surplus is in China, where they bought a lot of the crude oil for their reserves. But generally, the world right now at the moment is using less crude than is being produced. And ultimately that will get rid of this sort of gelatinous, like former governor of New Jersey's belly that we have in the US crude oil supply. The most likely 2020 scenario sees sort of a slow, torturous increase in the price of crude, fits and starts. We see, we think it bottomed in the second quarter. We see kind of a slow recovery. And again, we see 2021 as maybe an average price for Brent crude of about $44. Not very different from where it is now. but a really slow road and great difficulty to get to 50 to 55. You know, some of the banks that I have respect for think that the long-term price for crude in the next few years, the anchor prices are $40 to $60 a barrel. I think it's probably on the underside of that 60, but it's in that neighborhood. Again, those are those more ambitious expectations, but they do have a dog in that fight, as we say. You're going to see wild troughs and peaks again, particularly, you know, if there's some vaccines. You know, the Russians claim to have a vaccine. I don't know if it's called vodka myosin. In Poland, I think we have one called kilbasa-silin. I just don't think we're absolutely effective vaccines present themselves until sometimes in 2021. And we do have to worry about how many people are going to be willing to take the vaccine. And that's going to have a great deal to do with demand. Again, the loss of air travel tilts the scales towards too much diesel output and probably too much gasoline. And, you know, we have to be on the lookout again for that 30%, 40%, or 50% demand shock. So this is kind of the shape of the 2020 US economic recovery. You know, first you heard it was a recovery. Then you heard it was an M-shaped recovery. You know, it still might be. We're coming up a little bit on that end. More recently, you hear a lot of reference to the K-shaped recovery where, you know, there's a large percentage of the country which is doing much, much better, but there's a percentage of the country particularly attached to restaurants and retail and travel and leisure and whatever that are doing quite poorly. I think it's going to be what is, you know, you would recall, or what you would call a tilde-shaped recovery. Somewhere in the last 5 years, investment banks stopped saying things like about 90 million barrels or about 4 million barrels, and they started to use that little symbol that's there. And that actually is called a tilde, and it means about or approximately. Why it was not there for the first 30 years of my career, and now all of a sudden everybody uses it in analysis, I have no idea. But that's the shape that it might be. Okay, here's a little sort of football interlude. I'm in New Jersey now, we're a betting state. And these were actually the William Hill Sportbook's odds for winning the Super Bowl this year. Maybe we've got some Chief fans there. I know they had a good start. And you'll see, you know, I have to confess, I can't stand the Dallas Cowboys. My primary team that I root for each week is whoever's playing the Dallas Cowboys, so I do regard them as Satan's team. But in any case, if only there was an Energy Information Administration sportsbook, the Department of Energy sportsbook. They came out last week in their short-term energy outlook, and they suggested that 2021 gasoline demand would be 9.08 million barrels a day. Put that into context, that would be about 2.5% less than the last normal year, which was 2019. If I could bet on this, I would back the truck and bet on the under. I don't see any way in 2021 that we're going to average annually anywhere close to 9 million barrels a day. I think what we're leaning toward, and again, I don't want to be demotivational, is that if we get to 90% of what we saw in 2019, we're doing well, and a lot of people are doing well. And if I'm wrong, I pledge to you today that if I'm wrong, I will dress up in male rompers for the next ethanol thing that I'm invited to, if they ever invite me back again. I think, you know, I'd like to see Ron Lamberti take the other side of this bet, but we might need Omar the tent maker to make those rompers for him. And I think he might have those in his closet already right now. You know, another trend to watch, urban versus suburban versus rural. You know, for a long time, everybody wanted to live in the city. That was the big deal. All the kids wanted to go into the city and move there and not have cars, and we saw registrations being very, very low. Then we saw, or what we're seeing now, and this is actually a real picture. It hasn't been photoshopped. It's from a 2005 SNL episode where they recreated the Green Acres theme. And if you listen to a lot of companies right now, you might think that rural is going to be where it's at for 2021, 2022, and 23. Particularly with the public companies, a lot of them are in rural settings. They want to go rural, they want to do that. And they think that we're going to have kind of a rural renaissance, so to speak, of people moving there. I do think we're going to see not a mass migration, but an awful lot of folks leave the city because of telecommuting. And we're never going to see commuting go back to what it was in 2019. That's one of the reasons why I don't think we're ever going to see demand as high as we saw from 2016 to 2019 again. We thought the same thing back in 2007 when we approached 9.3 million barrels a day. But that was probably more of a calculus based on the high price of crude. Crude oil was $100 plus. Believe it or not, we had 4 years in a row where we averaged well over $3 a gallon for gasoline. So I still probably think that it'll be suburbia that benefits the most from, you know, the fear of COVID and the fear of mass transit and so forth. So we'll keep an eye on that. And again, here's just some take-home stuff. These are the prices that were headed into the weekend. The purple one stands out. That's California. And they have expensive gasoline, mostly because of high taxes and because of charging for carbon. I think that we are going to see some more purple on maps like this in years from now, particularly if the election, you know, one way and not the other. But I think climate change is real. I think suppressing carbon and diminishing the carbon footprint is real. And we're going to see a number of other states charge for carbon in some form or fashion. And finally, if you remember back to this earlier picture that I showed from CNBC, this is in Florida, by the way, and you see that nice background of Fort Myers. That's where I spend basically October through May. You know, before you take things too seriously or you realize that things are what they appear to be or whatever, here's the actual full picture from that day. And you can see a great pair of legs there, flip-flops and whatever. And something tells me that there's a lot of people watching this particular webinar or virtual conference, and they're dressed similarly if they happen to be in warm climates. So with that, I'm going to slip in our ShamWow Pocket Fisherman advertorial for something that we have at Opus. It's called TradeLink. Please explore it. It's made for the renewables business. We think that we have a solution to the lack of transparency and the lack of trading that we see right now, particularly for ethanol futures and RINs. And you know, I'd be glad to share more information on you or send you to the right people at Opus if you'd like to do that. And with that, I'm not sure if I filibustered too much, but I can take some questions, I suppose, if I'll throw it back to the operator here.
Tom, it looks like we have a question from Ron. How do you see diesel demand in 2021, and what impact might renewable diesel startups have on the market? Wow, I got to tell you, renewable diesel, you really, that is a big question, because there are some projects that are behind. There are so many announcements of projects, particularly in California, and we're waiting on those. I think renewable diesel, because of the low carbon fuel standard, the biodiesel blenders tax credit, and because of
you know, the nature of it, I think it's going to be a banner year for it. Now, across domestic diesel, we probably think diesel will come back when economic growth comes back. We'll have a lot more usage of diesel and a lot more transit across the country. So when I gave that for sort of where diesel demand is right now, we do think that it's going to come back to where, you know, we're going to be above 4 million barrels a day domestically, and probably will be exporting, you know, 1.3 or 1.4 million barrels a day. And we see renewable diesel as really the hot new product in the next few years. And now, how close are they to the schedules that they've announced, and how much permitting and sort of back order time is it going to take? I'm not sure. I don't think we're done with seeing some of the announcements on putting in renewable diesel, particularly where you're idling other plants. California, Cheyenne, you know, the Diamond Green Diesel projects down at the Texas Gulf Coast or Louisiana Gulf Coast. So it's, we're pretty excited about it. And I would like to find as much used cooking oil as possible. Maybe I can throw a potato in, make some potato chips and have a feedstock, because that's going to clearly be the question. Are there enough feedstocks to support what looks like a very, very profitable enterprise?